All right, let's talk about Nutanix. They just dropped their Q1 earnings, and wow, did it cause a stir. See, on the surface, some of the numbers looked pretty good, but the market's reaction? Well, that was a whole different story. So, we're going to break down exactly what happened. And when I say a different story, I mean the stock just got hammered. It dropped almost 18% in a single day. This wasn't just some minor pullback. This was a massive repricing that erased months of gains and really had investors asking, what is going on here? And that really brings us to the central question of this whole situation. Is this just a temporary hiccup? An issue with when they can book revenue, like management is saying? Or is this something more serious? A real crack in the company's growth story? The answer to that changes everything. Okay, so to figure that out, we've got to start with the actual numbers from the report. And honestly, it was a really mixed bag. There were some genuine bright spots, but they got totally overshadowed by one big miss that spooked everybody. So here's the disconnect right here. You look at the bottom line, their earnings per share, and it was fine, 41 cents, right in line with what Wall Street expected. But then you look at the top line, the revenue, and that's where the problem is. About $670 million, a miss. And in this kind of market, that's the number that grabs all the headlines. But this is where the story gets interesting, and where the bulls have a point. Their annual recurring revenue, or ARR, grew by a very healthy 18% from last year. Now, that's a super important number because it tells you the core subscription business is still firing on all cylinders. And get this, the company is also an absolute cash machine. They posted a 26% free cash flow margin for the quarter. So even with those revenue timing issues we mentioned, the business is still incredibly good at turning its operations into actual cash. And one more for you. This number points to future growth. It's called remaining performance obligations, or RPO. It's basically all the revenue they've already contracted but haven't recognized yet. That grew 26% year over year. So demand looks strong. With all this good news, why on earth did the stock crash? Well, the answer wasn't in the quarter they just reported. It was all about what they said is coming next. It was the guidance for the future that really spooked investors and sent the stock tumbling. This right here, this slide is what did all the damage. Management guided for full-year revenue somewhere around $2.84 billion. But the street? They were expecting something closer to $2.92 billion. I mean, that is a huge gap, and it immediately sent a signal to investors that, hey, maybe that Q1 revenue miss wasn't just a one-time thing. So, obviously, management had to respond to this brutal market reaction, and they came out swinging with a very clear, very consistent message. The business is fine. This is all just a matter of timing. The CEO, Rajiv Ramaswamy, put it pretty bluntly. He said, look, nothing has changed about how we see our business or how much new business or bookings we expect to sign this year. The message was simple. Don't confuse a delay in recognizing revenue with a drop in actual customer demand. And they really tried to back this up. They pointed out that bookings were actually a little ahead of their own plan. They're still pulling in hundreds of new customers who are leaving VMware. And here's the kicker. They actually raised their guidance for free cash flow for the whole year. That's a huge sign of confidence. The problem, they insist, is just that customers are signing deals late in the quarter and asking for the software to officially start at a later date. But, the market is a skeptical beast. Whenever a growth company has to cut its revenue forecast, investors can't help but worry that timing issues might just be code for something more serious, more structural. And management actually laid out 3 key reasons for this delay. First, those big VMware migrations are super complex, so customers want flexibility on when their Nutanix license kicks in. Makes sense. Second, more businesses coming through partners like Dell, and they can't count the money until that partner ships the hardware. And third, they flagged some potential supply chain hiccups and lumpiness in government deals. The big fear here is that these don't sound like one-quarter problems. So, all of that brings us to the final analysis. The big question is, where do we go from here? Let's weigh all the evidence and make our call on what to expect for the next quarter. Here's the whole debate in a nutshell, right? The bulls are looking at that strong recurring revenue and cash flow, the huge runway from the VMware situation, a stock price that's just been reset, and management's confidence in raising cash flow guidance. But the bears, they're laser-focused on the weak revenue guidance, the fuzziness around these timing issues, and the risk that comes with depending more on partners. Okay, so for the next earnings call, here's our take. We think revenue will probably land at the low end of their guidance range because these timing issues aren't just going to disappear overnight. That means the stock is likely going to be stuck in a trading range, let's say between $45 and $52, while the market just waits for proof. The single most important thing to listen for will be any hint that this timing problem is getting better or getting worse. So based on all that, our rating is market perform. The fundamentals, things like ARR and cash flow, are genuinely strong. You can't deny that. But the lack of visibility into revenue is a major, major overhang right now. We're staying on the sidelines until the company can really prove that the gap between the deals they sign and the revenue they report is starting to close. The bull case is compelling, for sure, but it's going to require some patience and some proof. And as always, please remember this is not financial advice.